On today's Hot Sheet, I'm discussing President Trump's big announcement yesterday about institutional investors, the FHA's annual report to Congress, November job openings, and weekly unemployment. Today is Thursday, January 8, 2026. I am Byron Lazine, and the Hot Sheet starts now. Okay, live from Connecticut, Byron Lazine here. Pleasure to be with you guys. Pleasure to see so many of you in the webinar yesterday, the calls webinar. Flory, if you missed yesterday's call, you missed out. I agree. It was action-packed. Myself, Tom Toole. It's the replays up on BAMX. So if you're a BAMX member in school, replays there. Call challenge starts on Monday. This Monday, January 12th, 30-day call challenge. Love to see you in there. Jumping at BAMX. We left the free trial open for you, 7-day free trial, school.com/BAMX. Join the call challenge starting on Monday. Spencer's ready to hit the phones. Let's go, brother. You'll get access to our Tuesday morning role play masterminds, 9 a.m. Eastern. You get the replays on those, obviously, and you get to follow along the entire call challenge. This is a season of action right now. And the president of the United States of America, Mr. Donald J. Trump, I believe. Haley says, yes, it is. She must be studying his autograph that you always see out there. President Trump has taken some action. He is, whether you love him or hate him, or you're somewhere in the middle on this guy, he is a president of action. You can't deny that. The dude is nonstop with actually sometimes these politicians, both sides, especially from the federal level, they say things and nothing ever happens. He said something yesterday that is getting a lot of attention. I mean, I've seen a million green screens on it already. He's made an announcement that he is here to save housing. I am here to save the day. Trump announces steps to ban institutional investors from buying single-family homes. So, I'm not going to say that this is virtue signaling like I did when the administration and, Pulte from the FHA said, oh, we're looking into portable loans and we're looking into 50-year mortgages and, oh, we're looking into turning the sky green and the grass blue. Like, I think portable mortgages is just a virtue signal of, trying to claim from a federal level that we're thinking about housing and we're thinking about the affordability. And we understand that the midterms are reliant on this. And we're going to send out a message that we're doing all these creative things. Now, this one here, I'm not going to say it's a virtue signal. No, I mean, I think when, there's something that, and I don't know if this can actually be done. This, I believe, would have to go through Congress. I mean, some things the president does don't they skip around Congress, obviously. But, I'm not going to second guess. This seems like something, portable mortgages, you need the banks to agree to. That's not going to happen. This seems like something that could happen, and maybe the administration sees this would be a political win. And so, I'm not going to say that this administration isn't going to do it. What I am going to say might surprise you. First, I'll give you the commentary from the president. For a very long time, buying and owning a home was considered the pinnacle of the American dream. And I think, for a lot of people, owning their own home, having the right home, having the ability to do what they want is still high up there on the pinnacle list. It was the reward for working hard and doing the right thing. But now, because of the record high inflation, that American dream is increasingly out of reach for far too many people, especially younger Americans. I don't know. He blamed the Democrats in Congress. I would blame all of Congress on record high inflation. They all wanted to print that money, and I would blame Jerome Powell for letting it happen. A little bit, I guess, of Joe Biden because he pushed for that extra $2.3 trillion and they gave it to him. Anyways, it is for that reason and much more that I am immediately taking steps to ban large institutional investors from buying more single-family homes, and I will be calling on Congress to codify it. People live in homes, not corporations. Now, Congress, with where we're at with the affordability issue, neither side. I think this probably gets bipartisan support, would be my guess. You don't want to be on either side of the aisle with midterms coming up saying, no, we want institutional investors to keep buying homes, because that won't really go well for them at midterms. So I think Congress does go here. Now, Trump's smart, him coming out making this big declaration, he's looking for the credit here as if this is a novel idea, not a very novel idea. And we'll see kind of how it goes, see how it works through Congress if they do this. So, Lance Lambert here in the BAM article, you can find everything on the BAM, nowbam.com article. We've even got the relevant tweets here. Lance and others have made the statement here. Hey, people live in these homes, not corporations. Okay. So, that is true. People live in these homes. And so, if, we're not saying that institutional investors have to go and sell these homes necessarily. They can't buy more, but if they have to go sell them, you're actually displacing somebody who's renting a single family home. Okay. So, that would be one thing to consider. Okay. Now, here's where I'm at. It's more in the line of where I would say Logan Mohtashami is at on this thing. Like, I'm not going to call this a virtue signal, but I'm not going to call it a big deal either, because it's not one. It's just not. It's not a needle mover. Look at the pie chart. I mean, that's a pay-per-click sliver of inventory. That is a needle. And this is not a needle mover. Institutional home ownership as of a total single family housing stock. Okay. First of all, everybody gets it confused. Everybody says BlackRock owns all the homes in the world. BlackRock doesn't own single family homes. So when you're thinking, how do I remember? Is it BlackRock or Blackstone? Okay. A rock is bigger than a stone. Would you agree, Haley? A rock? You would say a rock's bigger than a stone. A stone's like I think that's right. Fact check me if I'm wrong. Is a rock bigger than a stone? That's how I think about it.
I would agree. A stone's like a pebble.
Yeah. And so the little pebble, investor owns a little pebble, a little stone of single family housing stock. Blackstone owns 0.06% of single family housing. It is a little tiny pebble in the equation of single family housing. And then other institutional owned single family rentals, because there's other, and that's 1,000 and up homes, right? Own 0.5%. Okay, so we're talking about between Blackstone and other institutional owned homes, 0.56%. Okay, now you have heard and this is John Burns Real Estate Consulting providing this data. Now you've heard of the number 7%. You could play Sharon's. Let's play Sharon's breakdown of this. This was on the Now BAM Instagram, collabed with Sharon's Instagram. Sharon, obviously, BAM board member, and has great insights on this. He pointed out the 7%. That is, the recent purchasing rate of homes by Wall Street. So a 7% clip that they're buying, but that means there's 93% more homes. But that means that 0.56% number of institutional owned homes would go up if they continue at that kind of clip over the long haul. Let's go to Sharon's take on this.
Trump just said he's stopping Wall Street from buying homes to fix affordability. I ran the numbers. Please let me break it down for you. There are three things you need to understand. Number one, Wall Street is not buying as many homes as you think. Right now, the big investors, the big boys, buy about 7% of all single family homes, like the Blackstones of the world. 7%, that's it. But home prices are up over 50% since 2020. So if Wall Street is only buying 7% of homes, how did the home prices jump 50%? The math doesn't work. There's got to be more demand somewhere. Number two, we stopped building enough homes. After 2008, the builders totally pulled back for over a decade. Then all these crazy millennials hit their 30s and their 40s and all trying to buy at once. Then the rates dropped to like these historic low rates during COVID. And then the local governments have been blocking all new construction for years, like zoning laws and permit delays and all that stuff. So banning Wall Street, yeah, removes 7% of buyers, maybe, but it doesn't add a single new home. It doesn't lower your mortgage rate. It doesn't fix the supply problem. Here's number three. There's a trade-off that actually no one's also talking about. These investors are also landlords. If you ban them from buying, you're cutting the supply of rentals. So people who can't afford to buy right now may have fewer places to rent. And listen, I totally agree. Trump said he wants to keep existing homeowners wealthy and happy. I want that too, which means he doesn't want home prices to drop. But the real affordability means either prices have to go down or we have to build way more homes. So what is the fix? Build more homes, reform zoning laws, and make it easier to add supply. That is what moves the needle. That is what works. Banning Wall Street may remove 7% of the competition. But listen, the other 93% of the problem is still waiting for a solution.
Yeah. So, I think Sharon's exactly right on this. The impact here is minimal. Maybe the campaign messaging for the midterms is impactful. I got Congress to codify this. We stopped institutional buyers. Okay. And I'm not against it. I'm not against, Wall Street not being able to buy I'm not for or against. I actually could care less. I could really care less. And so I'm fine with it. I'm fine with them not being able to buy single family homes and rent that out. It doesn't ultimately solve the issue here that we're talking about in affordability. We just covered this week. It's rates, it's wages, or it's home prices coming down. And so it's a local problem. Again, the federal government, you're going to hear them do a lot of virtue signaling. I don't think this is in particular a virtue signal like some of the administration's past examples, like portable mortgages and stuff. Like they probably do mean this, whatever. But you're going to hear a lot of rhetoric from both sides of the aisle on we're going to fix housing, we're going to fix housing. And the reality is the federal government on both sides, Congress has very little levers to pull on truly fixing affordability compared to the people who live in your city, the people making decisions at the town hall, the people at the county hall who are making decisions each and every week, each and every month. Those neighbors of yours, NIMBY, not in my backyard, your neighbors are the people who are making the decisions that have the biggest leverage point on what happens with affordability in your community, zoning laws, permitting processes. And until the local governments, the local municipalities become efficient, sprinkle in common sense, use that as maybe a main ingredient to the dish. And maybe you, if it's a care that you have as a real estate professional, maybe you and a cohort of others that care deeply about this, maybe your office team, organization, get involved. It's a long process to change the minds of people who have seen things done a certain way for decades, who prefer nothing to change. But that would be the biggest impact. That would be the biggest lever to pull. So not against stopping institutional Wall Street, people who own 1,000 plus more single family homes. It's just not a big needle mover when we think about affordability. It doesn't turn things in any direction here in the near term. And we're looking for near-term solutions. The biggest near-term solution you can have is obviously rates, and people disagree that we should move the rate down. Some people are for it. Okay. This one, I think this tweet's pretty interesting here. Large financial institutions should not be buying up single family homes. Like, I can get with that. Okay. Cheers to that. I'm fine with it. I'm not totally not saying we should let institutions continue to buy up single family homes at a 7% clip. Okay. That 0.5% number does advance, does get higher. Number two, large financial institutions own such a small percent of single family homes. So let's also acknowledge where we're at. That's where I'm at. Like, maybe they shouldn't be buying it. And if Congress comes out and says, you know what, we don't want to, start restricting markets in this way, I could also see that argument a little bit too. I get it. The institutional buyer thing fires people up. If we look at why, I don't know why BlackRock's even in here. I'm going to have to talk to the BAM team about that. They put all the BlackRock but BlackRock gets into the discussions, even though, so they're getting roped into so we did reference this in the BAM arc. Good job, BAM team. Even though Blackstone, not BlackRock, is the firm actively involved in single family rental acquisitions, they're getting roped into the discussion because people online are uninformed, not the hot sheet crew, not the BAM community. We're informed. But you get the doomers that talk about BlackRock like, listen, whatever. People talk about BlackRock like it is an alien invasion coming to suck the blood out of their body and take it up to some unknown planet. I mean, that's how people talk about BlackRock. The doomers, where everything in the world's a big conspiracy against regular people, and we need to tear down the system, erase the dollar, and go to some whole other format here. Blackstone is buying properties, and there was a 5% dip on this news, on this announcement. BlackRock people just don't. They're just getting confused between the names. American Homes for Rent. This is a big one. Now they went up. Interestingly, they had a drop and then basically stayed flat for the day. After hours, they popped back up. So again, these announcements, the market reacts initially with the algorithm. Invitation Homes reacts down 6%. After hours, they're back flat. So, you've seen a million green screens already online, and they're saying stocks are dipping. When people take a reaction to the stock market in a 12-second because they ran to their phone on IG or TikTok, and they react about the stocks, it's like, dude, wait on the stocks, because if the wind changes one direction, the stock might change again. And so you already seen that in after hours where they're like, okay, they can't buy any more homes, I'll invest in something else. This hasn't even happened yet. And oh, by the way, they're not saying they got to sell these homes. So needle mover to affordability, no. Maybe something that Trump's trying to use as a midterm feather in his cap, I'd say probably true. Okay, FHA, speaking of the government, Federal Housing Administration, put out a annual report to Congress. This thing is crazy big. It's 159 pages. And the U.S. Department of Housing and Urban Development present this to Congress once a year. Okay, don't read the 159 pages. That would be an insane move. Just go to nowbam.com and grab the article that's posted this morning. Okay, we're going to break down exactly what you need to know. And if there's anything more as the team's picking through this report that is a need to know deal, we'll bring it to you. Okay. So here's one, and I've heard this throughout the year. Shout out to Deborah from Gary Ashton's organization, the CEO over at Gary Ashton's team. She brought me up to speed on this on a phone call earlier in the year. FHA annual report to Congress shows the agency entered the 2025 with a 11.5% capital ratio and proven borrower credit quality. First-time home buyers accounted for 83% of FHA purchase loans, expanded its market share to 19%. And today's risks are rooted in affordability and home prices, not loose credit. Okay, so that That capital ratio of 11.5%, okay, that is the most interesting piece of this entire 159-page puzzle. It means that FHA today, unlike during the GFC and the mortgage crisis, it means that today, right now, the FHA is financially strong. And the 11.47 in mutual mortgage insurance fund, the capital ratio, is at the high point we've seen since the GFC and the recovery started. Okay, so as of September 30th, it's the highest level on record. And it's far, 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 far above the 2% statutory minimum. If you look at 2013, the FHA, through the bailouts and everything, the mortgage crisis, mortgage collapse, this fund got depleted. And then the statutory minimum was put into effect of we need to have a 2% minimum here in case we have issues with the mortgage industry. That 2% minimum would help us get through any issues. We've covered it a million times recently. We don't have mortgage issues. We have the most 720 plus FICO scores on mortgages we've ever seen. That number's continued to go up since 2013. The laws that were put into effect in 2012 meant that you can't just give a loan to everybody. They need to be financially secure. Over 40% of homes are owned without a mortgage. Many homeowners have large amounts of equity. Okay? Just giving it in general terms there. So we don't have a loose mortgage standards and a mortgage crisis looming. No, not the case at all. The comparisons to 2008 are for people who want to clickbait the hell out of IG and TikTok. It's not for reality. And so there's no need for this 11.5% to be sitting in this federal fund. Okay. And so one of the thoughts here, and this is just a report of hey, FHA is financially strong. One of the thoughts here is actually, why don't you take that out and reduce the mortgage insurance for these FHA borrowers, which 83% of them are in fact first-time home buyers, to reduce the fees going into home ownership. Essentially reducing monthly payments by, $100-something on a median price home per month. Because you could take it right out of the fund. Because you could draw the fund down to the 2% statutory minimum, and because we're not facing a mortgage crisis. So use the money to solve the problem on the affordability of the first-time home buyers. I think it's an idea worth exploring. Again, it's one I'm going to credit Gary Ashton's CEO for bringing to my attention. And I know there are people talking to, and so this is, when I'm mentioning her, CEO of the Ashton Group of a Remax there in Nashville, I mentioned her. She's somebody that will engage local Tennessee, Nashville, Tennessee politicians on, hey, here are things that we need to. She's working the angles for affordability from the local government level. That's how it has to get done. So the economic net worth reached $188 billion, supported by a $1.64 trillion in insurance in force. FHA has now remained above the minimum capital threshold for 11 consecutive years. And so FHA report is what's happening beneath those stable numbers. While the overall capital ratio stayed flat year over year, the mix of performance shifted. Forward mortgage cash flows improved slightly, while reverse mortgage cash flows declined modestly. That distinction highlights where strength is building and where added caution is warranted. Okay, so they're carrying more of the market when Private capital pulls back, meaning FHA stepping in and filling that market void. Share of market by cohort. Expansion push FHA's market share to about 19%. And so maybe there's an argument that the 2% is too low because they have a higher share of market, versus previous years. It's a higher market share than, 13, 14, 15, 16, any of these recovery years. Okay. So maybe an argument to be there that it should be lifted up above 2%, but certainly not 11.5%. And it's important to obviously have protection here because FHA's first-time home buyers, primarily 83% of FHA purchase endorsements in 25 were first-time home buyers. It's 538,000 purchase loans. We only did 4 million existing home sales in the U.S. during that time period. So, and you could have first-time home buyers, obviously conventional. So this isn't all first-time home buyer loans, but that's a big chunk of the total sales were FHA loans. Here's FHA's loudest underwriting risk in this report to Congress. Okay, the industry focuses on 3 overlapping risk layers. Credit scores below 640. Haven't seen a ton of that over the last 15 years. Debt to income ratios above 40% and loan to value ratios above 95%. So those are the risk layers that they're underwriting on risk and determining, how much of that, if any, is a good thing. Loans carrying all 3 risk layers now make up 8.4% of the 25 cohort. So that's up from 2.6% in 2013. So monitoring that number and ensuring that it doesn't go too high is going to be really important. Remember, we're not back to normal foreclosure levels. Okay. Foreclosures, should never be zero. There should be some element of, taking a chance on people, giving people opportunity. It shouldn't be so black and white where there's zero foreclosures. Foreclosures is a good, healthy process in our housing market, and we're not even back to normal levels of foreclosures. So you can argue that going from 2% 13 to maybe 8% now might be the right lever to test where that sweet spot is. Cumulative home price appreciation, according to the FHA's report, is like all of them, up and to the right. Astonishing growth there. And what this might mean, okay? They reference here in this report what it might mean for that fund that I'm talking about, well above the 2%. We will review the report in greater detail to assess whether any policy changes are warranted to improve affordability and to access home ownership in 2026, including potential reduction in FHA's annual mortgage insurance premiums. This is an easy lever for the federal government to make buying affordable for first-time home buyers using FHA loan. There's been, as I mentioned, people in the ear of their local congressmen and women to bring this to the table. Look for this in 26. This is a real play that can happen and can have impact. A lot of it's going to be obviously local. This is a federal one. This is a lever that they could pull. Look for that to happen. Dive into it more, nowbam.com, where you can find the article. By the way, if you if you're new to the hot sheet here in 26, pleasure to be with you. Thank you for joining us. Nowbam.com is paywall free. We got a whole new skin here to the website. So a whole new layout, new format from the website in 25 here for 26. And everything you need is on here. No paywall. You don't have to remember a password. You have to do that 100 times a day. You don't have to do that here. Make sure you sign up for the Pro Bowl, obviously, February 4th, noon. right here in our events tab. You could sign up to all the events um, as they happen, and as well as obviously the audio versions of the podcast, newsletters, and all of the great content nowbam.com. Check it out. Don't have to remember your password. Okay. Bureau of Labor Statistics came out today with some jobs data. We're looking at this closely as we are now under 3 weeks away from the FOMC making their next decision. Job openings little changed at 7.1 million in November. And also hires were little changed at 5.1 million each. Separations were little changed as well. So we're watching jobs closely because it's going to impact the decisions, obviously, of the Fed as we come up in less than or just 3 weeks, I guess, from probably today on their or from yesterday. So yeah, under 3 weeks from their next decision, their January meeting. And we're looking at it because everybody's claiming how soft this job market is and how that can turn into a recession. The number of employed persons per job opening per this report right now are at 1.0, essentially where we were in 2017, 2018. And obviously that number got kind of all whacked out there during COVID. But you look at the last 15 years and you take out COVID spikes and then falls, you're at a low level in the last 15 years in normal times on this number, and still waiting for obviously the shoe to drop on this job market. Not dropping quite so much, not yet, not on this weekly data. Here's the initial claims for unemployment also released this morning. Initial claims for the week was 208,000. It's an increase of 8,000 from the previous week's revised level. And we're at a 4-week moving average of 211,000. That 4-week moving average has to get up over 250,000, which would take some big pops here on the weekly for really anybody to start getting really concerned on unemployment. We're not there yet. If you just want some local data on this, highest insured unemployment rates are in Washington, Jersey, Massachusetts, Minnesota, Rhode Island, Alaska, Montana, Nevada, Oregon, and Puerto Rico. And then the highest increases in initial claims, Jersey, Pennsylvania, Michigan, Connecticut, Missouri. Largest decreases in initial claims, Texas, California, Florida, North Carolina, Colorado. Okay. So pretty good job market there. 10-year off of this job news. 10 years obviously focused on the job news and what the Fed might do next. 10-year comes in today, tick higher than where we were yesterday. 4.177, near the 30-day highs, near the 5-day highs, and at the high mark over the last 24 hours. Also near the 90-day highs. So 4.177 is where we're starting today with the 10-year. The spread continues to improve on the 30-year, between the 30-year fixed mortgage and the 10-year treasury. And that's keeping rates low, and it's keeping them consistent, and it's keeping them steady. And LOs love this. 6.19, a tick down from the 6.2 on the previous day. We've been hanging out there for all of the new year. Poly market, here's what the DGens say. 93% chance no change on January 27th when the Fed meets. So no expected change coming. The administration makes a big announcement that they have plans to push Congress to ban institutional buyers from single-family homes. Still no announcement on the next Fed chair. Now, within 3 weeks of obviously making the decision. What's this comment? Byron's biased of what? Byron is way biased against Trump. I would say no to that. That's certainly not the case. I've listen. Just because I think portable mortgages is a virtue signal doesn't mean I'm biased against Trump. I'm just looking at each individual statement or yeah. So here's the deal: if institutional buyers who are supplying a rental home, um, are pushed out, what about those families? So one family can buy the house, but how about the renter who's saving money because they can't afford to buy? So, this is a complicated problem, um, in terms of obviously affordability. And, you know, I think the federal government overall does a pathetic job on, housing affordability. Um, I've said oftentimes I'm not biased against Trump and I'm not biased against the other. It's like I'm not biased either way. I've called Elizabeth Warren one of the biggest morons when she talks about economic policy and housing, who was ever born. I mean, I feel bad for people in Massachusetts who have to listen to her. She's a lunatic. And I think, some of the things that the other side of the aisle, and including when Pulte talks about portable mortgages, you're going to convince banks to do that. It's moronic. And so I'll just take each situation individually and go from there, and really just through a housing lens for us, so that we can better educate our clients, because our clients are 100% have an opinion on politics. We don't want to have an opinion on necessary politics. We want to be able to take those political headlines, and it's everywhere right now. The institutional buyers, oh man, I'm going to be able to buy if a buyer comes here, I'm going to be able to buy so many more homes in 2026 because the Trumpster is banning institutional buyers. Dude, they own 0.56% of homes. It's not going to impact your search. So we need the right plan, in the right areas, with the right financial plan, and we need to stick to the plan and the process that we're building here, because the White House isn't going to. What does Dave Ramsey say? If you're relying on the White House, he has some kind of line. I mean, it's not a good plan. Okay, so that's the deal with that. And listen, do I think this was a smart play by Trump to come out? Of course it is. He's got the midterm. This is phenomenal marketing. And I don't think it's a virtue signal. I think he's going to do everything he can to make sure that it happens. But it's just not a needle mover. It's not going to help a lot of people. So, all right, there you go. There's your hot sheet for today. Appreciate you guys. I love the commentary from living in Texas, or living in Houston. Give me more of it, brother. Appreciate you. And I'll see you guys back here tomorrow. Fridays are back on the hot sheet every Monday through Friday, when the markets are open. Love to see you guys in the call challenge kicking off January 12th. You can go to school.com/BAMX, try it out for free for the next 7 days. Till next time, toodaloo.